Hi, my name is Michael Pompian. I'm the founder and chief investment officer of Sunpoint Investments here in St. Louis. We are super excited to be doing a presentation today for the Exponent Philanthropy Conference. And before we get started, I wanted to introduce you to my partner of 17 years and president of Sunpoint Investments, Jack Dwyer. So we're going to go meet Jack now. And just so you know, so today a lot of the work that we're doing is based on my new book, Behavioral Finance in Your Portfolio, that came out a couple of months ago, and we'll be getting into that shortly. But before that, we're going to meet Jack. And here he is.
Hey, thanks, Michael. In addition to being the president at Sunpoint, I work with many boards, including ones associated with the University of Notre Dame, CFA Institute, and Our Lady's Inn, a maternity home for homeless women and their families here in St. Louis. You know, often because we're so busy, we use heuristics to try and make decisions quickly. Even though I've been in the investment industry and working with boards for over 20 years, I find that I often have to challenge myself continuously to try and avoid jumping to a conclusion and then defending it. I find Michael's work really useful in trying to challenge those beliefs and see biases in others. I'm really looking forward to the presentation and hope you all enjoy it.
Okay, terrific. So I'm going to start out by asking everyone a quick question. Which of these two lines is longer than the other one? So take a look, and is it A or B? Now, what most people do is they pick B. Why? Because it does look a bit longer than A, doesn't it? But if you actually measure it, the lines are exactly the same length. And a lot of times this happens in many different types of decision making, but particularly in investment decision making. And I'm going to give you a quick example of that now. So let's say you're presented with an investment idea that has in the past returned 10% with a standard deviation of 15%. That sounds pretty good, right? Well, is that an acceptable risk level? How the information is presented here affects how we make a decision. So what oftentimes people don't realize when it comes to the term standard deviation is that 2/3 of the time, the return, or in any normal distribution, but in this case, the return of the investment will fall within one standard deviation of the mean. And in this case, the mean, the average, is 10%. So if we look on the chart, we see that 2/3 of the time, it will fall between -5% and 25% of return. That doesn't sound too bad. But there will be times during the life of this investment, if it follows a normal distribution, that it will fall between -20 and 40%, or in very extreme cases, the probability being 1 out of 100, it may fall to as low as 35% or up 55%. And in fact, in 2008, we saw many investment returns fall outside of that 3 standard deviation investment. So how an investment is presented, or in this case, framed, and this is called framing bias, affects how we make an investment decision. And that's what this talk today is all about, is how we can make sure that when we're making decisions, we don't let our biases affect those decisions. And so it's really, when it comes to investment, the investment world, why are we here today? Well, on the left, you see the market gives us returns. That can be the stock market return, the bond market returns, the international and domestic, whatever the case may be, the market delivers a return. But numerous studies have shown that investors aren't always earning the returns of the market. And why is that? Most of the explanation is behavioral finance, meaning poor decision making, often the result of an undisciplined investment process. So how do we solve this? Well, I think one of the first places to start is education. Educate yourself on the biases that investors have. I've written 5 books on the topic. I just came out with my 5th book, which is called Behavioral Finance in Your Portfolio, a couple of months ago. We also have a website called michaelpompian.com. And on that website, you will see a behavioral investor type test, which has a test for investor biases. It's kind of fun. You might want to check it out. And then on sunpointinvestments.com, we have a number of papers I've written over the years that are pertinent to investment decision making. Just by way of background, I wrote the CFA exam curriculum at level 3 several years ago. And when you take the level 3 exam, you must read my materials, and there's questions on the exam taken from those materials. So in terms of today, what we're going to focus on is, first of all, the biases. This is the foundation. So think of, your house. When you build a house, it sits on a strong foundation. And in the behavioral finance world, the biases are the foundation. So we're going to spend a little bit of time going through the individual biases, of which there are 20 that I cover in my work. Second, we're going to see how the biases then are in turn used to create behavioral investor types, something that I created about 7-8 years ago that we further explained as we go through the presentation today. And then we're going to also talk about, once we do those two things, how you as a board member can make more effective decisions. And again, we'll see how to do that. And then lastly, we're going to see a video of an actual client and how we worked with that client to make better investment decisions for that board. So that's going to be the progression for today. So let's start to talk about the biases. Now, one of the biggest contributions that I made to the literature in behavioral finance was I organized the biases, the existing biases, of which there are at least 100 in the literature. Many of them sort of overlap, and they can be combined into one bias that's the meanings are similar. But I boiled it down to 20 biases. And when you look at the two types, one are called emotional and one are called cognitive. And emotional biases emanate from what you might think of as the old brain or the lizard brain, or the part where the emotions lie, which is called the limbic system. On the other hand, the neocortex, or the new brain, is where we have a lot of processes having to do with math and logic. And those are called cognitive biases, of which there are two types. One is called the belief perseverance biases, which essentially are a person has a belief and they have a hard time coming off of that belief once they have it in their mind. And number two are information processing biases, which are simply a person isn't thinking about the logic properly, or the information is not being processed properly. And so we're going to see different examples of these three types of biases, and they will add up to 20 as we go along. So we're going to start with belief perseverance, and really the most fundamental belief perseverance bias is what's called cognitive dissonance. And what cognitive dissonance is essentially people find it difficult to hold two opposing views in their mind at the same time. And then if I have one belief and then I'm presented with information that's counter to that belief, I have a hard time reconciling those two ideas. And I typically reject that second belief. And that's called cognitive dissonance, and really the foundational bias of belief perseverance. The second belief perseverance is called conservatism bias. And what conservatism bias is it's not being too conservative in your investing. What it means is that when somebody's actually made a decision, so they've gone beyond a belief and actually made a decision about something, and then they are presented with information that runs counter to that decision, again, they have a hard time coming off of that. So one of the clearest examples actually is on Wall Street. The analysts on Wall Street have a hard time coming off of earnings estimates. So if they make a projection that IBM is going to earn X number of dollars per share, and they receive information that may not be the case, they have a hard time coming off of that estimate. And there's actually some investment strategies around that concept. The third belief perseverance bias is called confirmation bias. And what confirmation bias is, essentially people believe what they want to believe and they reject information that runs counter to those beliefs. So one of the clearest examples out there right now is political television. So if you're a conservative thinker, you tend to watch Fox News. And if you're a more liberal thinker, you may watch MSNBC. Why? Because when we are watching these shows, they reinforce the beliefs that we already have. And so if you watch MSNBC, it's unlikely that you will just go and check out Fox News just to see what they're saying. You might check it out for a few minutes, but not take it, what they're saying, that seriously. And so that's confirmation bias. Representativeness bias is essentially the idea that humans like to see patterns in data. And so what sometimes they will do is they'll have a short set of data that they may view as representative of a larger set, but not include the larger set of data and then make faulty judgments off that small set of data. And that's called representativeness. Happens all the time in investing. Illusion of control is another belief perseverance bias where we may have been able to control some non-investment types of activities, like, for example, running a business, running a division of a company, et cetera, and having control over that, but then thinking that you can have control over the outcome of your investments. And often that is not the case. And the last belief perseverance bias is called hindsight bias. And this is the idea that when you're looking back on a certain time period or situation, it seems completely obvious. And of course I knew that when you're looking back on it, but while it was happening, it wasn't so clear that whatever that was, was happening at the moment. And that's called hindsight bias. It happens again all the time in investing. And we see that all the time as practitioners. So now we're going to move to the information processing biases. And anchoring bias is quite simple and quite common, is people get anchored to certain price levels, for example, of an index or price level of a stock. I bought a stock at $10 a share, and now that's the point or the anchor at which I'm going to decide to buy or sell or make an investment decision. And whereas the more rational thing is to look at the facts and say, is this a good or bad investment? So anchoring, very common. Mental accounting is the situation where what people do is they tend to put money in different mental or actual accounts. So money for spending, my monthly spending and vacation and travel or a retirement, education spending as well. So what happens there is that what people do is they tend to accumulate cash in each one of those accounts. And if you were to look at the group of accounts, you may see elevated levels of cash, suboptimal portfolio allocation. So that's mental accounting. Framing bias, I explained that one at the very beginning. How a situation is presented can have a big effect on how a decision is made. Availability bias, that's the tendency for people to use information that happens to be available to them and perhaps discount or not seek information that's not available to them. So one of the examples I like to use here is if you're doing a Google search and what tends to happen is you look at the first set of results, maybe go to the second page. If you're really adventurous, go to the third page. But you know what? There could be info on pages 9, 10, and 11 that could be relevant to your search. And so you want to make sure that you're thorough in your researching. Self-attribution is the idea that if a situation worked out, an investment worked out, oh, that was because of my great decision making. And if something didn't quite work out, that's somebody else's issue. So that's quite simply self-attribution. Outcome bias is where people tend to look at the outcome and make a decision as opposed to looking at the process. So if you were to look at let's say a bond manager that's earned 4% over the Barclays aggregate, the big bond index, and you think to yourself, oh, well, 4% over the last 10 years, that's a great record. I'm going to invest there. Well, what kind of risk did they take to get there? So you can't just look at the outcome. You've got to look at the process by which that was earned. And lastly, recency bias is the situation where people tend to look at the most recent data, but not look at or discount in a longer sets of data. So for example, using that same idea of a manager track record, you might look at the last 1 year and the manager's outperforming by 5 or 10%, but has been and you think, oh, that's great, but has been underperforming over the last, say, 5 years. So you don't always want to focus on the most recent. You want to focus on the entire track record and how they got there. So that's recency bias. So now we're going to focus on the emotional biases. And we're going to start with affinity bias. So here, what happens is people get emotional about the investments that they make based on how they feel about a certain company. So for example, if you're a Tesla owner, you may buy Tesla stock. Now, Tesla's been a great investment, but there are examples where there have been great products and really bad companies. So that's affinity bias. Regret aversion. So this is the idea that you either take action or most of the time don't take action because you don't want to look back on a decision and regret the action that you took. And this is an emotional response. There's really no logic to that. Endowment bias is a situation where if you already own something, you attach more value to that than if you didn't already own it. So for example, let's say a big donor gave a large amount of Berkshire Hathaway stock to a foundation 20 years ago, and it's still in the foundation holdings. Well, it's now become, let's say, 50% of the foundation. So is that a smart thing to do? Probably not. I mean, Berkshire is a great company, but having 50% concentration in one stock is not a good idea. Well, some board members might say, well, don't forget that was gifted to us by XYZ. Well, you have to look at that rationally and say, if you were going to buy Berkshire today, would you buy 50% of the portfolio? And oftentimes the answer to that is no. So that's endowment bias. Status quo is the idea that people just are afraid to take action. The status quo is preferable to taking action. We see this all the time with low risk tolerance investors. Self-control, another emotional bias, which is that if we're making a lot of money, let's say it's good times are good, the idea of spending more becomes more appealing. And so that what can happen there is if you overspend, that can really put a dent in your long-term investment plan. So self-control, it tends to be an emotional oriented bias. Overconfidence is simply unwarranted faith in one's own investing abilities. We see this a lot of times with very aggressive investors, feeling very confident about their decision making, but not necessarily having a big justification for that. And lastly, loss aversion, which is perhaps the most famous bias in terms of the literature. Daniel Kahneman, professor at Princeton, won the Nobel Prize for his work in prospect theory, which is the basis of which is loss aversion, which essentially says that the pain of losses is 2 times the pleasure of gains. Of course, it varies by client, but his work showed 2 times. And that's a summary of the emotional biases. Now, I know that was a bit long, but I wanted to give you a framework for the biases so that we can move on to investor types, which we're going to go to now. So in my work, I identified 4 investor types: the preserver, the follower, the independent, and the accumulator. And we're going to review these in a bit more detail shortly. But what I want to first point out is that when we go from the preserver, which is the least risk tolerant, as you can see on the top chart there, the follower, the independent, and accumulator gradually take on more risk. So the most risk tolerant is called the accumulator. That's the first thing to keep in mind. The second thing to keep in mind is that certain types are driven more by the emotional biases that we talked about versus other types which are driven more by cognitive biases. The preserver and the accumulator, the least risk tolerant and the most risk tolerant, are driven by emotional biases. And if you take nothing away from today, I hope you take that away, that when you're dealing with very low risk and very high risk, those are more emotionally oriented investors. And by the way, those tend to be more challenging to work with because feelings are more difficult to change than thoughts. How you feel about something is how you feel about something. Difficult to change. And when it comes to the cognitive biases, the follower and the independent are driven more by those cognitive biases. And we're going to delve into this a little bit more. So when it comes to identifying the biases associated with each type, we see the preserver, which is the least risk tolerant, you might expect has loss aversion. They just don't like to lose money. Nobody likes to lose money, but they feel that loss more acutely than others. Excuse me. They may have endowment bias where they don't want to give up something that they already own. So that's an emotional attachment. Status quo. Oftentimes, low risk investors don't want to make a lot of changes. Fear change. Anchoring bias. They may get anchored to certain price levels and not want to take action, and also may engage in mental accounting. Again, holding large amounts of cash across multiple accounts is definitely a preserver orientation. On the opposite case, meaning the high risk case, yet emotional biases, you see overconfidence. Very high risk tolerance investors are very confident typically in their opinions. They may have self-control issues. Times are good, I'm going to buy an extra car or something like that. They may look at the outcome of something happening. More recent performance has been good. They look at the outcome, not necessarily the process. Illusion of control. They may have controlled some sort of business activity and think they can do the same in investing. Often not the case. And then they may have affinity for things that, let's say, the people at their work or their club are investing in, and they want to do that too. So again, emotionally driven. When it comes to the follower, so this is a slightly higher risk tolerance than the preserver, but not a big risk taker. And they tend to think they might want to invest in high risk things, but when things don't work out, they realize their risk tolerance isn't really that high. So how things are framed to them. So back to that standard deviation example, they may invest in higher risk things based on how it's explained. They may have regret aversion, not wanting to take action and fear they may regret it later. Cognitive dissonance we talked about. And they also may have recency bias. We're only looking at the most recent data, being in the ones that are performing the best right now. Lastly, the independent. Think of the independent as the engineer type, the one who likes to look at a lot of data. They may have looking at data and doing research is great, but there can be some biases that may get in the way. So conservatism that we talked about, making a forecast or making a decision, and then you're presented with new data, you may not like that. And so coming off of that original decision is difficult. You may be subject to availability bias, only researching data that's available. Confirmation, seeking information that confirms your belief, but not necessarily runs counter to your beliefs. Seeing patterns and representativeness where none exists. And then self-attribution. If an investment worked out, that was because of my great research. And if it didn't work out, well, that's probably somebody else's issue. So those are your 4 types, and those are the biases associated with those particular types. Okay, so I'd like to stop for just a moment and ask you, do you see any of these biases in your own decision making, or do you recognize, are you a certain type of investor? So I just like to take a moment and see if anyone has any thoughts on that. Okay, so hopefully you were able to resonate with those biases and investor types that we talked about. But now what I'm going to do is I'm going to get into a little bit more on a description of the types, and so that we have a firm understanding, and then we're going to move to how we can all make better decisions as board members or donors. So the preserver. So again, low risk tolerance, emphasis on financial security, preserving wealth. May have gained wealth through inheritance, don't want to risk capital to build wealth. They may worry about what's going on in the markets, obsess about short-term performance, and not think about the long term. May be slow to make investment decisions, meaning they don't want to make any changes. They're uncomfortable with change, and may be supportive of emotional things like funding education or home ownership. The follower is, again, medium to low risk tolerance, but they're often following the lead of their friends or colleagues, or following the herd, as it were, by being in the latest investment fad. And what often happens there is you just invest at exactly the wrong time when valuations are peaking, for example. So got to be very careful about keeping that long-term plan in mind when it comes to followers. And when they do make something that works out, invest in something that works out, they may think, oh, I'm a smart investor. One of the phrases that comes to mind is confusing brains with the bull market, an old Wall Street term. And in particular, how things are framed or explained to a follower type can make them make decisions in different ways. So that's the follower. Again, the independent, a little higher risk tolerance, so medium to high risk tolerance. They're independent thinkers, strong-willed. When they make decisions, they trust their gut, but they could have some biases. For example, they may not be as thorough with their research, make an investment without consulting anybody, may seek information that confirms their beliefs rather than finding opposing views. But oftentimes they enjoy investing, but they may not want to follow a plan, and they're most likely to be contrarian, which isn't necessarily a bad thing. Being contrarian is good, but you just got to be careful to what extent you are contrarian. Lastly, the accumulator, the highest risk tolerance. They tend to be quick to make decisions, confident in themselves. They like to be hands-on with investment decision making. Like to take risks, but of course don't like it when markets are going down. They may be entrepreneurs, first generation to control wealth, and they may have this illusion of control where they've controlled a business, for example, and they think they can do the same with their investment portfolio. They may be susceptible to self-control, spending a little too much on, cars or lifestyle enhancements, and they may chase investments that their friends are investing in, similar to a follower. So those are the 4 types of investors. And so now comes the where we're going to learn, in terms of a board member, how we can put this information to use. So let's first outline, what is the problem? So if you're in a group decision-making setting, the challenge that often comes up is agreeing on a risk level or overall strategy for the portfolio. Also having trouble understanding where each other is coming from in terms of investing style or risk-taking level, etc. Therefore, making joint decisions can be challenging around, what the portfolio allocation should be, what types of managers, should be used for the portfolio. That what happens is, in order to find, harmony with everyone, you can have this concept of groupthink, where everyone's sort of thinking the same and not making great decisions. And we want to avoid that. So let's just say that you you listened to this presentation today, but none of the other members of your committee did so. Okay. And what happens is you went to michaelpompian.com and you took the little investor type quiz, excuse me, and you found out that you're an independent. But you're looking around the room and thinking, what are the other types, investor types? I know I learned that Michael Pompian was telling me about the various types. What do I think each of the board members are? And as you go around the room, you start to realize that you have one as an accumulator, one as a preserver, and the other one is also a preserver. So you have 2 preservers and an accumulator, and you're the independent. So you're sort of the rational thinker out there. You have cognitive type of biases, but you learned about them, so you're aware of them. So what's the first thing that should come into your mind when you're dealing with preservers and accumulators? Well, the first thing that should come in to your mind is that we're dealing with emotional investors, as we talked about. So you are more of the cognitive thinker, and you're dealing with a group of emotional investors. And so as we learned earlier, emotionally driven investors are some of the most challenging to deal with. So then we have to ask ourselves, how do we best handle this situation? And that's what we're going to do now. We're going to summarize a bit and say, you're the rational one, you're driven by cognitive biases, you're dealing with board members that are driven by emotion, again, more difficult to deal with. So what is the best way to handle this board situation? Now, I would be remiss in saying, if I didn't say that one of the things is that an advisor in the room who's skilled in these areas can very much help to facilitate the situation. But let's say that there isn't an advisor in the room and you yourself are trying to figure out the best way to handle this. Well, what we're going to do is we're going to show you how we at SunPoint think about these issues and how we deal with them in practice with our clients. So when you have a situation where you're seeing irrational behavior happening in a investment committee, a meeting, whatever the case may be, there's really 2 choices that you have in terms of dealing with that, and in terms of a framework for decision making. And the 2 choices are: one, you can try to change the viewpoint of your board members or the other people that you're dealing with, which I call moderating behavior, or you can adapt the portfolio decisions to the board members, which isn't always necessarily an unwise thing to do. But the question is, how do you decide whether to moderate or adapt? And this goes back to my earliest work, going back 15 years ago, still very relevant today. Things have not changed. People are people. Institutions are institutions, decisions are decisions. It doesn't really change that much. The rule number one, the most important rule is protect financial security. So for example, if your foundation has a 5% spend rate, you really don't want to, you want to make sure you earn that 5%, hopefully. Of course, there are years when you're not going to do that, but you want to have as your expected return something higher than 5%, else you're going to start to eat into your principal. Rule number two is adapt to emotional biases where possible. Remember, the emotional biases are the more difficult to change, and moderate the cognitive biases, which are thinking biases, which are a bit easier to change. So let's look at how a framework for how we apply these biases in practice. So let's say that we have a situation where we have a foundation portfolio that has as its expected return 7%. So we're clearly covering our 5% spend rate. But you're noticing that a lot of the biases or the investor types on your committee are more emotionally driven, and they think that there's the foundation is taking too much risk to earn the return. And so, as a specific example, let's say that the portfolio allocation is 80% risk and 20% non-risk or risk mitigation, and the portfolio has been doing well, but they think that's too high. Well, what you can do in this case is, because you have a low risk to financial security, meaning you are earning the return you need, but you have emotionally oriented biases, what you may be able to do is adapt the portfolio to meet the emotionally driven board members. So perhaps what you decide or you propose is to move to 75-25 as opposed to 80-20. Your expected return went from 7% to 6.6%, still over your 5%. But in this case, you adapted to that situation, and you can feel good about doing that. Conversely, let's say you're in a situation where your portfolio is too conservative. So let's say you have a 40% risk, 60% risk mitigation portfolio, but you're noticing in your boardroom that most of the board members are, let's just say, the engineer types, the independents, or the followers, and who have cognitively oriented biases. So rather than and so you're under, your expected return is below 5%, and you really do have a risk of financial security there. But because you're dealing with cognitive biases, the appropriate course of action in this case is to try to change the behavior or change the views of those board members, to try to take more risk. And so hopefully with facts and figures, which cognitively biased investors tend to relate to, you can moderate that behavior or that decision. Okay, and as you might expect, in the other two cases, it's really a judgment call. If you're dealing with a higher risk to financial security, but also emotional biases, it's going to be a judgment call. You're going to have to moderate and adapt, figure out what the best situation is. Not as clear cut. And the same with cognitive biases and low risk, moderate and adapt. Of course, I've oversimplified here, but this hopefully gives you a mental framework for how to think about these decisions in your own unique situation. So one of the questions I get a lot is, well, how do I speak to my fellow colleagues about these issues? And a very big picture, simple way to think about this is cognitively biased clients or board members tend to want to deal in facts and figures. They relate to ideas like standard deviation, returns, those kinds of logic things. Whereas emotionally driven clients tend to want to feel more heart language or having to do with how they feel about things. So again, back to our example of the emotionally oriented board members, if you don't necessarily want to talk about quantitative things, but more heart oriented or emotional feeling types of arguments. So I'm going to summarize some, again, ways to speak about this behaviorally, or ways to approach different types. Is when you're dealing with a preserver, you don't really want to talk about quantitative. If I tell somebody that's really nervous about the markets that the standard deviation is low enough that you don't need to worry about it, well, that's probably not going to work with a preserver who's more emotionally driven. In terms of followers, they tend to overestimate their risk tolerance. So what you should do is believe half of what they're willing to risk, and then you can move on from there. Independent, you want to collaborate with them and educate them as best you can, because they respond to facts and figures. Accumulator, they tend to be emotionally driven investors, and very confident and quick to make decisions. And if you have a different viewpoint than what they have, what you need to do is respectfully stand your ground and make your points against that emotionally driven investor. So that's a bit about how we can work with in terms of behavioral types. So back to our group. So how are we going to best deal with this situation? Well, what we're going to do is in our after chat session, we're going to discuss this specific situation, and any questions that people have, or any, it doesn't have to be this particular makeup. We can change the makeup to be more cognitively oriented versus emotional, different biases, different types. And now we're going to move to the next part of our presentation, which is an interview with one of our clients discussing behavioral finance. I have Carol Littman here, who is a client of SunPoint, and we are going to ask Carol some questions and go over how behavioral finance and our education process has helped their committee. So Carol, first of all, can you tell us a little bit about your background and the nonprofit organization that you're involved with, please?
In 1980, I started as a sell-side analyst at A.G. Edwards & Sons. In 1986, I got my CFA charter. And I've been in this financial services profession for more than 4 decades. So I moved over to the buy side as a portfolio manager, and with 2 other business partners, we purchased Dearborn Partners several years ago. So I'm in a place now where I've decided to take the 4 decades of work that I've, done, trying hard to learn. I certainly don't profess to be an expert in all things, but I think I've learned a lot, and want to try to help other people get a better return on their money without losing a lot, hopefully along the way. So I have decided to offer my services to volunteer and serve on the investment committees of a number of nonprofit organizations. And so one of these is a pension plan, which is actually about $30 million for the beneficiaries of the plan. And they have 7 volunteer board members on the investment committee. 2 of us are investment professionals, and the rest are stakeholders, but and intelligent people, certainly, but just don't know our business. So with this diversity of backgrounds, a number of the members had their own views about how the portfolio should be managed and how it had been managed. And so loss of principal is very important to some people, but some of the people on our committee were most concerned about fees and just investing in investment vehicles with the lowest fees, without particularly paying attention to how well diversified the portfolio was, or whether active management on a after fee basis might actually offer superior results.
Okay, so can you tell us a little bit about how the portfolio was managed prior to selecting SunPoint about a year ago?
It was essentially just 2 separate portfolios. There was the equity portion and there was the fixed income portion. And there was probably an investment policy statement created years earlier, which set probably the 70% for the equity portfolio, the 30% for the fixed income portfolio. But these 2 managers stayed very much within their own silos. And there was really no one to oversee the whole thing, to determine whether, in fact, this is the correct asset allocation now, these many years later. Certainly when the investment policy statement was created, I would suggest that interest rates were a lot higher than they are now. So even though both managers were doing their narrowly defined jobs very well, there was little consideration for the overall risk management at the entire portfolio level. And there were, it was really not well diversified. Furthermore, it was heavily skewed toward a value orientation. In my opinion, and in the opinion of others, we needed someone to take a top-down view of determining whether the investment policy statement was still valid in today's environment with, the benchmark long-term bond below 1% at the time that we decided to send out for RFPs. We had a portfolio that needed guidance at the top as to prudent asset allocation now and ongoing supervision and guidance going forward. So finally, many of the personalities and of the board, with the people that were just focused on getting the lowest fees and so forth, these were part of the reasons why we hired SunPoint, because we felt that their ability to provide investment-related education to these board members, and with the background that SunPoint has in behavioral finance, that this could help create a more cohesive investment decision-making process for this investment committee of this pension plan.
Okay, so on that point, Carol, what specifically did SunPoint do to make the decision-making more cohesive, and how did that impact how the portfolio was managed?
Well, the first thing that SunPoint did, and by the way, none of the other consultants or advisors that submitted RFPs did this. So this was unique to SunPoint. It was really effective, is that SunPoint sent a survey to the board asking questions that would both help reveal everyone's risk tolerance for the portfolio and identify our behavioral biases. And the results found that we faced a common problem in today's market environment, that being that this particular pension plan's projected withdrawals from the portfolio required a relatively high return. And several members were nervous about the amount of risk that we were taking. And as I said, with the yield on the 10-year Treasury bond below 1% at the end of 2020, when we were going through all of this, bonds may have offered an alternative to equity risk, but not much in the way of expected returns. And furthermore, if yields went up, as I said, the value of the portfolio, that portion of the portfolio could go down. So many of us were nervous about that. And so the results of the survey also highlighted the differences in behavioral biases that I mentioned earlier. By understanding more about the initial assumptions of each individual on our committee, we were able to help prevent one member of this committee from trying to guide the entire group down the wrong path. So SunPoint really, I thought, did an outstanding job of kind of corralling all of these personalities and getting everyone to understand the proper way that we needed to go, in our opinion.
Thanks, Carol. So you mentioned education that we at some point brought to the board. Can you give us one example of that education and how that helped to manage the portfolio process?
Well, during an early meeting, the committee focused on selecting an appropriate asset allocation for the portfolio, and the SunPoint team took time to not only provide data about equity risk being higher in the short run and in the long run, but also help members understand the long-term impact of accepting a lower expected return. And the result was that after a fair amount of backing and forthing, we settled on an asset allocation with which everyone was comfortable, including, this is one of the things that I like so much about SunPoint, is that they know about and introduced to us some strategies that didn't fit just neatly into the traditional bond and equity bucket. And yet, though there were different constraints that we had to consider, that offered returns certainly superior to, like today, I think the 10-year Treasury bond yield is a whopping 1.11%. SunPoint brought a lot of advantages to our committee and to the pension plan for this particular entity.
Okay, terrific, Carol. Well, listen, so thank you so much for your time. We really appreciate it.
Good luck, Michael.
Okay.
Stay well. Thank you. Bye-bye.
Yeah.